The American dream is built on more than innovation. It thrives on leverage. The US has long bought its place on the global stage, not with gold, but with promises, IOUs. From humble beginnings, this system grew into an economic empire. The world's prosperity is inextricably tied to America's debts. But what happens when IOUs become more than promises? What happens when the debt grows faster than the trust? The world may be living on borrowed time. Sound familiar? The American dream didn't just come from innovation, it was built on leverage. But that leverage wasn't always what it seemed. America's power didn't rest on the dollar alone. It rested on promises, the IOUs. This was the foundation of a financial empire, a world built not on gold, but on trust. What happens when that trust is tested? An IOU or IOU is a written promise to repay a debt. In simple terms, it's a form of borrowing where one party promises to pay back another party at a later date, often with interest. In America's case, the government sells IOUs through bonds to raise money for various purposes, from wars to infrastructure. America's rise to power in the 20th century was nothing short of miraculous. A country forged in the fires of revolution and civil war, now poised to dominate the globe. How? It wasn't through traditional wealth, not gold, not natural resources, but debt. The US began building an empire, not by spending its own money, but by borrowing from the world. The US government issued bonds, essentially selling promises to the public that they would be repaid with interest. At first, the promises were small. War bonds, the kind of bonds the US issued to fund its early wars, most notably World War I. These were more than just financial instruments. They were symbols. America was building credibility. And with that credibility came power. The power to borrow. The power to get other nations, businesses, and ordinary people to trust their government. And as they did, America grew. But this wasn't just about raising money for war efforts. It was about something deeper, something bigger. By borrowing money from its citizens and from foreign nations, America wasn't just raising capital, it was creating a system that was based on trust. Trust that the government would repay, trust that the bonds would remain valuable. This, ultimately, was the foundation of the American financial system. And it's a system that grew stronger with every dollar borrowed. The rise of bonds allowed the US to play a role no other country had managed: global financial leadership. By the time World War II rolled around, the US was holding the world's debts. This was when the US dollar became the world's reserve currency, a decision made by the global powers that fundamentally reshaped the economic landscape. America wasn't just a player, it was the referee. The system of IOUs began to spread worldwide, with the US at the center. But what happens when IOUs become more than just promises? When trust starts to outgrow the system that it's built upon? When the whole world starts to run on borrowed money? What happens when the music stops? That's where we'll go next. And we'll look at the moment this system began to tip over, when it became less about trust and more about leverage. The mechanics behind America's financial power are deceptively simple. The US doesn't just rely on wealth, it creates it. But it's not about raw resources or gold. It's about promises, IOUs. The power of the US dollar isn't just in its circulation, it's in its status as the global standard. And with that status comes influence. The US dollar is the cornerstone of global trade. It's not just money, it's a promise. A promise that holds weight, not just in America, but across the globe. Nations hold US dollars because they believe in the security of that promise. But here's the kicker. That promise is backed not by gold, not by tangible assets, but by America's ability to repay its debts. And the more trust America gains, the stronger the US dollar becomes. So how do these IOUs work? It starts with bonds. Bonds are promises, plain and simple. The US government issues bonds to raise capital. Essentially, they sell a promise to pay back the money with interest. For a country like the US, this system is vital. Bonds allow the government to collect money now, while guaranteeing repayment later. It's an immediate exchange, money for promises. And this isn't just a domestic affair. Foreign governments, institutions, and even individuals buy into these promises, strengthening the US economy in ways that most people don't realize. But here's the unseen hand behind all of this: the Federal Reserve. It's the Federal Reserve's role to control the flow of money, to regulate interest rates, and to make sure that these IOUs don't collapse under their own weight. The Federal Reserve creates more dollars to pay off existing debts, ensuring that the system stays afloat. This creates a feedback loop. More debt leads to more dollars, which in turn leads to more debt. It's a carefully controlled, finely balanced dance. But what happens when debt grows faster than the economy? What happens when these IOUs outpace the ability to repay them? When the trust in the system begins to erode? This is where things start to get risky. Trust is the engine that drives this system. But what happens when that trust falters? We'll explore the consequences next, the point where leverage becomes too much to handle. When a system built on trust and IOUs starts to face cracks. Borrowing started as a tool, a means to an end. But over time it evolved. What began as a necessity turned into a system, a machine that runs on debt. And as the machine grew, so did the power it provided. The more debt, the more influence. Borrowing became not just about survival, it became a symbol of prosperity. More debt equals more power. That's the logic the system runs on. The US government borrows more, and in return, it holds more sway over the global economy. But it's not just the government. Businesses and individuals follow the same model. Leverage isn't just a financial tool anymore, it's the key to success. The more you borrow, the more you can expand, the more you can grow. And this growth isn't just on paper, it's real. It shapes industries, nations, and entire economies. But leverage has a double edge. It is a tool that builds power, yes, but it also builds inequality. The very same system that allowed America to dominate the world also left millions behind. Those who could access credit and leverage prospered, and those who couldn't. They fell further behind. The rich became richer, and the poor became poorer. Borrowing didn't just redistribute wealth, it created a new class system. A system where the wealthy could borrow and use their debt to grow their fortunes, while the rest of society struggled to keep up. The more you borrow, the more you owe, and the more you owe, the more you're at the mercy of the system. For the wealthy, this is an advantage. For the average citizen, it's a trap. This growing gap between those with access to credit and those without fuels the borrowing machine, and this machine is powered by trust. Trust that the system works. Trust that borrowing will lead to more prosperity. But there's a cost to this system. It's not just about the money, it's about the power dynamics it creates. Those with the ability to leverage debt can control more of the economy, and those without, they watch as the system tightens around them. Debt is more than just numbers. It's a system. And when it starts to break down, it won't just be a financial crisis, it'll be a crisis of trust. What's at risk? The very fabric of the system we've built, a system that's teetering on the edge. And as we push further into debt, the cracks start to show. The system was built on trust, trust that borrowing would lead to prosperity. But what happens when trust breaks down? What happens when that delicate balance shifts and the machine built on debt begins to unravel? In 2008, the world found out. The financial system, once thought to be unshakable, came crashing down. What started as a mortgage boom, driven by an insatiable appetite for debt, turned into a global disaster. The housing market, the cornerstone of the financial boom, collapsed. And with it, so did the illusion of unending prosperity. The debt binge had gone too far. The system was overloaded. The housing bubble was a microcosm of the entire system. At its core, it was simple. Lenders, driven by greed, issued risky loans to people who couldn't afford them. But it wasn't just the banks. Investors, eager for returns, bought into these toxic loans, bundled them, and sold them as safe investments. The entire system was built on shaky ground, but everyone was convinced it was solid. Then the crash came. The entire financial system buckled under the weight of its own creation. Banks collapsed. Millions lost their homes. The middle class, already struggling with debt, was hit hardest. What had once been seen as an unstoppable economic engine now looked like a house of cards. And at the center of it all was leverage, a tool that had built fortunes, but at its extreme had destroyed them just as quickly. The systemic collapse wasn't just about bad loans, it was about trust. The belief that debt could solve anything had faltered. When people realized that the system wasn't built to sustain the kind of debt it had taken on, panic set in. Banks scrambled for bailouts, investors scrambled to recover their losses. And the government, the very institution that had been selling the promises, stepped in to prop the whole system up. This wasn't just a financial crisis, it was a crisis of trust. A moment where the foundations of the system were revealed to be fragile. What had been sold as innovation, new financial products, complex mortgages, unregulated markets, had become the very thing that broke the system. Does history repeat itself, or is this time different? As we look around today, we have to ask ourselves, are we building a new house of cards? The answer might be coming faster than we think, and when it does, it may not be the financial system that breaks, but the trust we place in it. Excessive debt wasn't the cause of the crisis. It was the symptom, the visible crack in the system, but not the underlying flaw. Debt has always been a tool, a necessary evil in the mechanics of finance, but debt alone doesn't explain the collapse. There's something deeper at play, something that's been forgotten in the pursuit of prosperity. Trust. Trust was once the currency. But that trust is no longer enough. Trust has been replaced by debt. What we've built isn't a financial system, it's a house of credit. The US economy, once driven by a sense of shared purpose and trust, now runs on borrowed money. The faith that debt would always be repaid is what sustained this system, and when that trust started to erode, everything else came crumbling down. The real cause isn't the debt itself, it's the mindset we've adopted. Borrow today, pay later. This is the illusion of perpetual growth, the belief that the economy could grow endlessly without consequence. And for a time, it worked. The economy expanded, the middle class grew. But beneath it all, the belief that debt would always be repaid was the foundation of our entire financial structure. But now, the debt isn't just a tool, it's become the system. And with it, the illusion of unlimited growth has collapsed. The borrow today, pay later mindset has given way to a harsh reality. The future, it turns out, is now. And as the system crumbles, it becomes clear that the real transfer taking place isn't just in money, it's in power. Debt redistributes power. It consolidates wealth in the hands of those who control it. The wealthy borrow, leveraging the system to grow their fortunes. Meanwhile, the average person, trapped in a cycle of consumer debt, watches as the wealth gap grows. The government borrows more, and with every dollar, it strengthens its control over the economy. The invisible wealth transfer takes place through national debt, a transfer that widens the gap between the wealthy and the rest. It's not the debt, it's what's been forgotten. The trust in the system that once made everything possible. The trust in a future that was supposed to always be bright. What's the cost of that trust? The answer is unfolding right before our eyes. And the next question is, who will pay? The systems we have today are reflections of the past. The names and methods may have changed, but the underlying principles remain the same. The world still runs on borrowed money, and the architecture that once built America's empire has now spread globally. The tools are modern, the risks familiar: apps, derivatives, and digital IOUs. These are the new financial products, and they're just as elusive, just as abstract as the bonds and promises of yesteryear. Apps today allow consumers to access credit instantly. Derivatives, financial products that bet on the future, are the modern version of promises, except they come wrapped in complexity. They let investors place bets on everything from interest rates to company performance, but it's all built on the same fundamental thing: debt. The real power behind these tools is the same as it was in the early 20th century: leverage. But today the stakes are even higher. Not only are we borrowing money from one another, but the global economy has become intertwined with US debt. The dollar is still the world's reserve currency, and countries worldwide hold US debt as part of their economic strategy. From China to Europe, nations are bound by the same system that fuels the American economy. They hold US Treasury bonds, buying into the promise that the world's most powerful nation will keep paying its debts.
The risks are clearer now.
The risks are clearer now. If the US falters, the entire world feels it. This interconnectedness has created a fragile balance. The world's economy no longer functions independently. It's tethered to the health of the US financial system. When America borrows, so does the rest of the world. The leverage is shared, the contagion is global. But what happens when the system breaks? When America can no longer afford to pay its debts?
The consequences of widespread dependence are more far-reaching than we've ever considered.
The consequences of widespread dependence are more far-reaching than we've ever considered. If the US defaults, the global domino effect would be devastating. In a world of digital IOUs, no one knows who's really holding the debt and who will be left holding the bag. The question is no longer just about the US economy, it's about the world economy. We are all interconnected, and this system of debt is its lifeblood. But for how long can it keep running? How long can the world continue borrowing from a system built on borrowed time? Trust was the currency that built the system. But now, trust has become the most dangerous commodity of all. Confidence in the system is no longer just a foundation, it's a liability. Trust in the system is its own danger. The belief that everything will continue as it always has, despite the cracks beneath the surface, is what keeps the machine running. But it also makes it more fragile. Moral hazard, the very idea that people or institutions will take risks they otherwise wouldn't, because they believe they won to bear the full cost of failure, has become embedded in the financial system. When banks know they'll be bailed out, when investors can gamble with other people's money, when governments borrow endlessly because they believe they can always refinance, they are playing a dangerous game. The problem isn't the debt itself, it's the belief that it can be managed forever. Leverage isn't just a financial tool, it's a mentality that has shaped how we view growth, success, and even risk itself. Leverage isn't just about using other people, money. It's about believing that using more and more money in increasingly risky ways will always lead to more. But as we've seen, that's not a law of nature. It's a psychological trick.
A mindset that forgets the fundamental rules of economics. Growth has limits. Debt has consequences. Trust has an expiration date.
A mindset that forgets the fundamental rules of economics. Growth has limits. Debt has consequences. Trust has an expiration date. But the system hasn't just shaped the economy, it's shaped our future. Leverage, once seen as a tool of success, has become a force that drives inequality and economic instability. It's a mentality that propels the rich to more wealth and traps everyone else in cycles of debt. The system is working for some, but it's not working for most. And when the next crisis hits, the first to fall will be those who trusted the system the most. So, what can we take away from all this? What signals should we be watching for before the next crash? The growth of debt versus GDP. When debt grows faster than the economy, it's a red flag. Sustainable growth isn't possible without a balance. Rising inequality, a widening wealth gap signals an economy propped up by leverage, not real growth. Unregulated financial innovation. When financial products become more complex than ever, without transparency, that's when risks are being hidden. Liquidity is not solvency. Trust can't be built on borrowed time. So, are we ready for the truth about debt? Or are we still living on borrowed time? The system is more fragile than we realize.
The next chapter of this story is yet to be written, but we all have a role to play in how it ends.
The next chapter of this story is yet to be written, but we all have a role to play in how it ends.